TWR versus IRR, explained for executives. Clear English for reports. Welcome. Today we'll demystify two returns you see in reports: time-weighted return, TWR, and internal rate of return, IRR. They answer different questions with different metrics. TWR highlights the manager's skill at growing assets, independent of when money moved. IRR captures the investor's experience, including the timing of deposits and withdrawals. Knowing which one to use prevents mixed messages. Pitch TWR when comparing strategies or managers. Use IRR when discussing how your actual dollars performed. By the end, you'll know which metric fits your audience and how to explain both with confidence. Think of TWR as the manager lens. It neutralizes cash flow timing by treating each period between cash flows separately. We break performance into sub-periods. For example, between each contribution or withdrawal, then measure the growth in each slice. We then chain-link growth rates across those slices to get one clean return. Because client cash moves don't distort the result, TWR is best for comparing managers or funds on skill. If two clients invested on different dates, TWR still tells you how the strategy itself performed, not how lucky or unlucky the timing was. Here's plain language for TWR. We isolated pure investment skill by removing the effect of deposits and withdrawals. Your cash in-out didn't distort results. This is the strategy's performance. Then add context. Show benchmarks and peer ranks to prove whether results beat the market or competitors. Also explain volatility and fees. For example, higher volatility drove wider monthly swings, and after-fee returns are X% lower than gross. This framing helps stakeholders judge manager quality without confusing it with investor timing choices. Now, IRR is the investor lens. It solves for the discount rate with NPV equals 0, meaning it finds the single annualized rate that makes all cash flows and the ending value balance. It's highly sensitive to cash flow timing. Early gains help more than late gains, and late losses can sting. That's why IRR is common in private markets and projects, where capital is called and returned over time. It reflects the actual money-weighted path your dollars traveled, capturing contributions, distributions, and final value in one intuitive number. Use IRR to make the experience tangible. This is your lived return with cash flows. Show a simple timeline of contribution and distribution dates so people see what drove the number. Discuss reinvestment and pacing risk. Cash returned in a hot market may be hard to reinvest at the same rate. Then compare IRR to a target hurdle or cost of capital. Our 12% IRR exceeded the 8% hurdle by 4 percentage points. That ties performance to decision thresholds, making the result actionable, not abstract. A quick rule: use TWR for manager evaluation. It answers, how did the strategy perform, independent of cash timing? Use IRR for capital planning. It answers, how did my actual dollars perform, given when I invested? Whenever possible, report both for a full picture. Skill plus experience. Also flag distortions. Very large flows can skew short-term IRRs, and short windows make both metrics noisy. Setting expectations on these limitations keeps your audience from overreading any single number. Keep language crisp. For TWR, say, skill, independent of deposits. For IRR, say, return on dollars you timed. Avoid tossing out alpha/beta without context. If you use them, define how you calculated each. And always anchor claims to data visuals, a benchmark chart for TWR, and a cash flow timeline for IRR. Simple phrases plus clear visuals reduce confusion, help non-specialists follow the story, and make your recommendation feel grounded, not hand-wavy. When presenting, lead with a metric that fits the decision. If it's manager selection, start with TWR. If it's budgeting or pacing, start with IRR. Add the other for balance, so leaders see both skill and lived experience. Explain drivers, not just numbers, flows, fees, volatility, and market context. Close with a one-line takeaway for the board. The strategy outperformed peers on TWR, and investor IRR cleared the 8% hurdle. Recommend maintaining allocation and pacing commitments on schedule. Clear, fast, and decision-ready.